In this latest video on trading biases, we're going to look at stop losses. What are they there for? And why still do so many people have problems with them? Hello, I'm David Jones from Capital.com, and this is the latest of our videos where we take a look at trading biases. Now, our trading platform has an algorithm that will try and examine client behavior and see if certain clients have picked up biases or bad habits, and hopefully try and nudge them in a direction, like this video's, to try and hopefully correct those biases. This time round, we're going to take a look at stop losses. This is one of two videos that we're doing on stop losses. And first of all, what we're going to look at, what are we actually trying to achieve by using a stop loss? And then also, why do so many people either not use them or place them incorrectly? Let's take a look. So let's take a look at some of the reasons why people might not use stop losses. First of all, what is the purpose of a stop loss? It's to have a predefined level of risk when you enter a trade. A stop loss also enforces the discipline of exiting the trade when the stop is actually hit. If you place the stop loss with your broker, it's automatically executed when the market gets that level. And of course, the purpose of a stop loss is all about keeping risk to a manageable level. So no one trade should do significant damage to your trading account. It's keeping losses at a sensible, manageable level. So this all sounds very logical, but why do some people not bother setting stop losses? Conspiracy theories. I have heard a few over the years. Some people think if they put their stop loss in the market, then the evil market will move and take their stop loss out before going exactly the way they thought it was going to be. This is clearly nonsense, but it's one reason why some people won't place stop losses. It's highly unlikely that you're trading big enough for the market to get pushed to find your stop loss. You're just a very small speck when it comes to trading markets. Plenty of people don't have a trading plan, so they'll think, well, I want to buy gold, but they don't have a plan for getting out if their view ends up being proved wrong. So the stop loss doesn't really exist in their mind because they don't have that plan in place. And perhaps the biggest reason is an inability to admit when they are wrong. Nobody is right all the time when trading, and a big part of trading success, perhaps the biggest part, is keeping losses to a manageable, small level, and when your winning trades move in your favor, letting them run far enough to make a decent profit. So to be able to do that, you do of course need to admit when you're wrong, and that's where stop loss is coming. But if people have a problem in admitting they're wrong on a trade, then one way of avoiding that responsibility is not setting stop losses. Let's take a look at some real examples of where not setting stop losses could really hurt your trading. We could pick up on lots of examples, but I've picked a popular market here, the Dow Jones. So the Dow Jones, this is in early October. The Dow Jones is trading around about 26,500. And you may decide the market is going to rise here. It has been rising. We've been in an uptrend. The RSI down here is oversold. So you may decide to buy at 26,540 because you think the market's going to rise. But let's say you have a problem admitting when you're wrong. So you decide not to place a stop loss. Let's jump forwards in time. Not long after the trade was placed, the market sold off incredibly heavily. It sold off by around about 1,000 points. So you bought in at 26,540, or our trader with no stop loss brought in at 26,540. Maybe a sensible place to have a stop loss would have been under the recent lows, around about 26,200. So a risk of, in this example, about 340 points. But you can see by not having a stop and just sitting there, maybe like a deer frozen in the headlights, the trader ended up with a much bigger loss than that person would have been banking on. So stop losses get you out of extreme moves when you're wrong. So you come away with a manageable loss and you don't sit there with the market going quickly against you in a major direction, racking up much bigger losses than you were planning. Of course, you can use stop losses in both directions. If you're selling shorts, let's take a look at Brent crude oil here. It was trading just below $80 a barrel. You may have thought, well, actually, this market is going to run out of steam, $80 is too expensive, I'm going to sell short. So you may have a stop loss at $81 a barrel. If the market gets there, take me out of the trade. But let's say we did a trade with no stop loss, selling, here we are at 79.66. What happens next? So you can see this is where we were looking at the market initially at 79.66. It started a move that extended for another $6, about $6.50 from where the short would have been put on. If you had a stop at 81, would have been taken out there for a small loss in this example. But if we didn't have a stop loss and just stuck to the position, hoping the market was going to turn around, we ended up racking up a much, much bigger loss that we could have avoided by using a stop. So the stop loss is there to manage risk. It's to get us out of a trade when our opinion ends up being proved wrong. It's a way of admitting we're wrong, and if we're placing the stop loss with the broker, that's something that happens automatically. Next time around, we're going to take a look at maybe how to set more effective stop losses. There's of course a whole host of other content on our YouTube channel where we have various market outlooks for all sorts of different markets out there, and also looking at trading strategies. But from me, David Jones, and Capital.com for this latest session on trading biases, we'll wrap things up there.